Hey everyone! Welcome back to another exciting episode of Trader DNA. If you're having trouble being a successful trader and looking for a trading setup that can help you stand out in the market, you're in the right place. In this video, we're going to reveal 3 awesome ways to enter trades using price action. These techniques will really boost your trading account from the start. So, let's get started right away. To start off, we'll begin by explaining the crucial concepts of supply and demand zones in trading, focusing on price action. Afterwards, we'll unveil our top-performing price action entry strategies that have proven to be highly profitable in both the forex and stock markets. If this subject piques your curiosity, we kindly request your support by giving this video a thumbs up and subscribing to our channel if you're new. So, let's understand what a supply and demand zone is. A supply zone refers to an area located above where the price has repeatedly failed to break through and has been rejected multiple times. From a price action perspective, the market perceives this area as expensive, leading buyers to close their long positions and sellers to open their short positions. The combined effect of these actions is what triggers the price to reverse from the supply area. Now, let's talk about something different. A demand zone is like a special area below the price where it's hard for the price to go down. It's like a place where the price keeps bouncing back up whenever it tries to go lower. When the price is in this area, traders see it as a good deal because it's like buying something at a low price. This makes the sellers stop selling and the buyers start buying. All these actions together make the price turn around and go up again from the demand area. Now, let's delve into some of the important supply and demand areas on the chart that we deem as optimal trading zones. The first significant level to consider is the turning points. In this example, on the 4-hour time frame chart, as you can see, the market was experiencing a long-term downtrend until it reached this specific price level, where the trend reversed. These levels act as traditional resistance points. However, what holds greater importance for us is this turning point, which the market perceives as extremely undervalued. This is why we identify this level as an extreme demand zone. If the price reaches this level once again, it could potentially present a perfect trading opportunity. Now, let's take a closer look at this 1-hour timeframe chart. It's like a rollercoaster ride as the market keeps swinging back and forth between going up and down. In between those major turning points, we have these smaller swing levels that play an important role. They act as support and resistance areas, kind of like invisible walls that the price bounces off. But here's where things get really interesting. The turning points are like supercharged supply and demand levels. They can offer some of the juiciest trading opportunities because the market has recognized them as either ridiculously cheap or incredibly expensive before. Next, let's explore the major levels of the market structure. A major level of structure refers to a zone that meets 3 specific conditions. First, the zone must have been rejected multiple times. Second, it should have acted as both support and resistance in the past. And third, it should have been respected by the market in recent times. When these conditions are met, we identify it as a major level of structure, and it has the potential to provide highly accurate trading entries. Take a look at this daily chart. This particular level has been rejected multiple times, acted as both support and resistance, and has been recently respected. Now, when the price reaches this level, notice how many times the market has reacted to this level along the way. All we need to do is patiently wait for a suitable entry signal on a lower time frame to open a position. This strategy can significantly improve our chances of successful trading. Now, let's explore another example on this chart using the same concept. This trade presents multiple conditions aligning together. Firstly, we have a major level of structure. As a result, we anticipate the market to reject this price level. Additionally, we observe the presence of a bearish trend line, which could indicate a potential trend reversal. Furthermore, there is a strong candlestick that strongly rejects this area. Now, pay attention to this crucial point. When multiple price action concepts converge in a specific area, it creates an optimal opportunity for high probability trading entries. Since many traders focus on this area, they will take action when favorable trading opportunities arise. So, keep a close eye on such areas as they can offer great trading prospects. Moving on, let's discuss higher time frame key levels. Many of the key levels you come across on lower time frames may not be visible when using daily, weekly, or monthly time frames. However, the visually obvious levels on higher time frames hold significant importance. These higher time frame key levels are of very high quality, as price often reacts strongly to them. Even a minor reaction can lead to a major reversal on lower time frames. In this example, we are looking at a monthly time frame, and these visible levels are what we call monthly areas. Now, although we don't trade directly on higher time frames, here's a technique you can employ in your analysis. Label the closest levels in front of the current price as monthly levels. By identifying and paying attention to these significant monthly levels, you can enhance your trading analysis and decision-making process. Now, let's shift our focus to the weekly time frame. Here, we'll fine-tune the monthly levels by considering the price action reflected in the weekly candles. Additionally, we'll draw new weekly levels if they become apparent. Moving on to the daily time frame. We repeat the process by adjusting the monthly and weekly levels based on the daily candles. By employing this technique, you gain the ability to see the bigger picture and identify the major levels of structure, even when you're actively trading on lower time frames. It helps you develop a comprehensive understanding of the market dynamics and enhances your decision-making process. For example, when the price reaches these monthly levels, it presents a significant profit potential, whether there's a reversal or continuation. Similarly, when the price reaches these daily levels, the offered profits are relatively smaller compared to the monthly or weekly areas. This difference in profitability potential is unknown to almost all amateur traders. And now, you understand it clearly. Let's dive into the setups we use to enter trades. But before we proceed, please take a moment to hit the like and subscribe buttons if you've been enjoying this video so far. Alright, let's dive into the world of price action trading setups. We have two main types: trend continuation and reversal. First, let's focus on trend continuation setups. The trend continuation trading strategy is a method used by traders to capitalize on the ongoing direction of a prevailing trend in the market. This strategy assumes that the current trend will continue and aims to enter trades that align with the existing trend. By identifying key levels of support and resistance and using technical indicators, traders can look for entry signals that confirm the continuation of the trend. This approach allows traders to ride the momentum of the trend and potentially profit from extended price movements in the same direction. As you can see in this monthly chart, we have identified monthly key levels that will serve as references for lower time frames. As I mentioned earlier, we cannot execute open positions on the monthly time frame chart. Instead, we need to place our trades on the daily or 4-hour time frame. In this case, based on the monthly key levels, we will analyze price action on the daily time frame chart. Here, after a false breakout, the price rises and forms a higher low and higher high. This indicates that the price is likely to continue rising in line with the monthly trend. The best place to enter a buy position is after a pullback. Here, we observe the formation of a bullish engulfing pattern at a higher low position. This indicates that the pullback is likely coming to an end. What you should do is open a buy position above the bullish engulfing candle. Place your stop loss below the swing low. Since the basis for this position is the monthly key level, the potential profit you can gain is significantly higher compared to the risk you take on. Now, let's dive into a key reversal trading setup that can be quite valuable in your trading arsenal. The trend reversal trading strategy focuses on identifying potential changes in the direction of a prevailing trend. This strategy aims to capture profit opportunities by entering trades early when a trend is expected to reverse. Reversal trading can be challenging, but I'll share with you a technique that combines higher time frame key levels with reversal patterns for greater effectiveness. In this trading setup, we'll be using two time frames. On the higher time frame, our goal is to identify a significant level of structure. As mentioned earlier, this refers to a key level that has served as both support and resistance. Let's take a look at this monthly time frame chart. It's quite evident that the price has reached a strong key resistance level on this monthly chart, which is also known as a supply area. On this chart, you can clearly see that for over 10 years, the price has consistently failed to break through this supply zone. This indicates that it's highly likely that a reversal is imminent, similar to what has occurred over the past 10 years. Therefore, when facing a situation like this, all banks and other institutional traders would surely prepare themselves on smaller time frames to identify signs of a reversal and take a sell position to maximize their profits from this situation. And now, let's move to a smaller time frame, specifically the weekly time frame chart. Well, it turns out that the situation is quite straightforward in terms of price action. The reason behind this simplified situation is that all banks and institutional traders have their eyes set here, preparing to take a sell position in the near future. You can observe the signs on the weekly chart. A doji has formed, signaling a warning to all market participants to get ready to enter the market. This is followed by the formation of a strong bearish pin bar below the doji, indicating a shift from a warning doji to a bearish doji. This is a confluence condition that indicates a high probability of an upcoming reversal, with the price becoming bearish until it reaches the monthly key support area or the demand area. Let's initiate our short position below the bearish pin bar candle. To effectively manage risk, we'll place our stop loss above the high of the pin bar candle. It's important to keep in mind that reversal trading demands patience and comprehensive analysis. By combining significant levels with reversal patterns, you can strengthen your trading strategy and improve the probability of successful trades. So let's have a quick recap of this reversal setup. First, we identified a major level of structure in front of the market on the higher time frame. We expect the market to reject this extreme supply area and possibly give us a selling opportunity. So we zoom into the lower time frame and look for a reversal price action pattern, double top, triple top, bearish engulfing, bearish doji, bearish pin bar, and etc. In this case, the bearish doji and bearish pin bar indicates that the market failed to establish a new high, signaling a loss of upward momentum. This suggests that the monthly uptrend has come to an end and the market may start moving downward. As a result, we opened a selling position with our stop loss placed above the swing high. Remember, these trading setups can be applied across various time frames and markets. However, it's essential to conduct your own back testing to determine which pairs are most suitable for these strategies. You can perform all of these analyses manually. As a powerful tool that greatly aids and speeds up your work in finding the best trading opportunities in all markets, you can utilize this indicator, as shown in the video. With this indicator, you'll be able to easily, quickly, and accurately identify markets that are currently at key level areas, allowing for further analysis of price action on smaller time frames to make decisions for opening positions. If you find this tool beneficial for your price action analysis, then you're on the same page as me. So, in this video, I've included a template with the system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link in the description. So, guys, that wraps up this video. If you found it helpful and informative, please show your support by giving it a thumbs up and subscribing to our channel if you're new. Thank you for watching, and we'll catch you in the next episode.